Most people have heard of a trust. Very few understand that there are two completely different kinds of trust, and that the one most people set up does almost nothing to protect their assets from nursing home costs, lawsuits, or estate taxes. The one that actually protects you is the one most people are afraid to use because of a single word: irrevocable. In the last episode, we talked about Medicaid planning and the 5-year look-back rule. The strategy that keeps coming up, the one that protects your home from estate recovery, removes assets from Medicaid's reach, and can shield wealth from creditors, is the irrevocable trust. Today, I am going to explain exactly what an irrevocable trust is, why you lose control of your assets when you put them in one, and why for millions of Americans, that loss of control is precisely the point. I am Marcus Webb, and this is Benefits Decoded. Here is what we are covering today: what an irrevocable trust actually is, and how it differs from a revocable trust. Why giving up control is the mechanism that creates the protection. The 4 main types of irrevocable trust and what each one does. When an irrevocable trust is the right tool and when it is not. The mistakes people make when setting one up. And your 30-day action plan. Before we get into the mechanics, I want to tell you about a man named Robert. Robert was a 67-year-old retired contractor in Arizona. He had a revocable living trust, a will, and a financial advisor. He owned his home outright, worth $420,000, and had $400,000 in retirement savings. He felt prepared. His advisor had told him the trust was set up correctly and everything was in order. 3 years after he retired, Robert was diagnosed with early-stage Parkinson's disease. His neurologist told him that within 5 to 10 years, he would likely need significant care assistance. Robert began researching nursing home costs in Arizona. He found that the average was over $8,000 per month. He did the math. 4 to 5 years in a nursing home would cost between $400,000 and $600,000. His entire savings, his house. Robert called his estate planning attorney and asked, "Is my revocable living trust protecting my assets from Medicaid?" The answer was no. A revocable trust offers no Medicaid protection, no asset protection, no creditor protection. The assets inside it are still legally yours. They are fully countable for Medicaid purposes. His trust was excellent for avoiding probate and managing his estate, but it was not protecting anything he was worried about protecting. His attorney explained that Robert had a 3 to 5 year window while he was still healthy and cognitively intact to make decisions that would matter. One of those decisions was whether to fund an irrevocable Medicaid asset protection trust with his home. If he did it now, the 5-year clock would start. If his Parkinson's progressed to the point where he needed care before the clock cleared, the transfer would still be subject to a Medicaid penalty. But if it cleared, his home would be fully protected from estate recovery. It would pass to his children. The state could not touch it. Robert transferred his home into a properly structured irrevocable trust. 2 years later, he is still managing independently. The trust is in its 3rd year of the 5-year clock, and his home is on track to be fully protected by the time he is likely to need care. He made that decision because he understood what an irrevocable trust does. He overcame the fear of losing control, and he acted while he still had time to act. Now, let us talk about exactly how this works. The difference between a revocable trust and an irrevocable trust comes down to one thing: who controls the assets. A revocable living trust is one where you remain in control. You are typically your own trustee. You can change the trust at any time, add assets, remove assets, sell property, spend money, and dissolve the trust entirely if you choose. Because you retain this control, the law treats you as still owning everything in the trust. For tax purposes, the assets are yours. For Medicaid purposes, the assets are yours. For creditor purposes, the assets are yours. The revocable trust is an excellent tool for avoiding probate and simplifying estate administration. It is not an asset protection tool. An irrevocable trust is one where you give up control. Once assets go into an irrevocable trust, you cannot take them back. You cannot change the terms of the trust. You cannot direct the trustee to return your money or property. You have made a permanent transfer to a legal entity that is separate from you. Because you no longer own those assets, they are no longer counted as yours for Medicaid, for creditors, and potentially for estate tax purposes. The loss of control is what creates the protection. This is the concept that trips most people up. They hear irrevocable and they think, I am giving my house to someone else forever. But that is not quite right. You are transferring legal ownership to a trust you create with terms you set for beneficiaries you choose, administered by a trustee you select. You can retain certain rights, including the right to live in your home. In the case of a Medicaid asset protection trust, you can retain an income interest in certain types of trusts. What you cannot do is take the principal back. Now let us look at the 4 types of irrevocable trust people most commonly use. Type 1, the Medicaid Asset Protection Trust. We covered this in the last episode. You transfer assets, most commonly your home, into an irrevocable trust at least 5 years before you apply for Medicaid. After the 5-year look-back clears, those assets are fully protected from both Medicaid eligibility counting and Medicaid estate recovery. You can retain the right to live in the home. Your children or other beneficiaries receive the home at your death outside of probate, outside of the reach of the state's estate recovery program. The critical detail, the trust must be properly drafted. A common mistake is a trust that gives the grantor, the person who created the trust, too many rights. If the trust language allows you to receive principal distributions under certain circumstances, Medicaid may still count those assets as available to you. The trust must be designed so that you have access to income only, not principal, and even that varies by state. This is not a do-it-yourself document. A single drafting error can void years of planning. Cost to set up, $2,000 to $4,000 with an experienced elder law attorney. Potential protection, hundreds of thousands of dollars in home equity and savings. Type 2, the Irrevocable Life Insurance Trust, also called an ILIT. This type of trust is designed to keep life insurance proceeds out of your taxable estate. Here is the problem it solves. If you own a life insurance policy at the time of your death, the death benefit is included in your gross estate for federal estate tax purposes. In 2025, the federal estate tax exemption is approximately $13,700,000 per individual. Most people are comfortably under that threshold, but that exemption is scheduled to be cut roughly in half in 2026 when the Tax Cuts and Jobs Act provisions expire. For estates between $5 and $7 million, that change could create a significant estate tax bill. An irrevocable life insurance trust owns the life insurance policy instead of you. Because you do not own the policy, the death benefit is not part of your taxable estate. The trust collects the proceeds and distributes them to your beneficiaries according to the trust terms. The trust can be structured to provide liquidity to your heirs, cash to pay estate taxes, buy out a business interest, or simply supplement an inheritance. The rule: you must survive at least 3 years after transferring an existing policy into an ILIT for it to be excluded from your estate. If you die within 3 years of the transfer, the IRS pulls it back in. The cleaner approach is to have the trust purchase a new policy directly, so there is no 3-year look-back issue. Type 3, the Special Needs Trust. A special needs trust is designed for a family member with a disability who receives or may need government benefits, Medicaid, supplemental security income, or other means-tested programs. The problem it solves: if you leave money directly to a disabled beneficiary, that inheritance can disqualify them from the benefits they depend on. A lump sum inheritance of even $10,000 can result in a loss of Medicaid coverage at a time when that coverage is essential to the beneficiary's health and quality of life. A properly structured special needs trust holds assets for the benefit of the disabled person without counting those assets against their benefit eligibility. The trust can pay for things government benefits do not cover: personal care items, recreational activities, transportation, education, vacations, electronics, and supplemental medical care. The trustee manages the assets and makes distributions in a way that enhances the beneficiary's life without displacing their benefits. There are 2 main types: a first-party special needs trust, funded with the beneficiary's own assets, such as a personal injury settlement, and a third-party special needs trust, funded by parents, grandparents, or other family members, leaving assets to the disabled person. The third-party trust is the more common planning tool when parents are creating an estate plan that includes a disabled child. The mistake: leaving money directly to the disabled person in your will, or naming them as a direct beneficiary on a life insurance policy or retirement account. The same amount of money held in a special needs trust instead of paid directly can serve the beneficiary for decades without disrupting their benefits. Outside the trust, it can disqualify them from Medicaid within months. Type 4, the Charitable Remainder Trust. A charitable remainder trust is used when you have a highly appreciated asset, real estate, a business interest, stock that has grown significantly in value, and you want to sell it without paying capital gains tax on the entire gain in 1 year. The mechanics work like this: you transfer the appreciated asset into an irrevocable charitable remainder trust. The trust sells the asset. Because the trust is a tax-exempt entity, it does not pay capital gains tax on the sale. The trust then invests the full proceeds and pays you an income stream, either a fixed annuity payment or a percentage of the trust's value each year for a specified period or for the rest of your life. At the end of the trust term, the remaining assets go to one or more charities you name when creating the trust. What you gain? The income stream is substantial because you are investing the full pre-tax proceeds rather than the after-tax amount. You also receive a charitable deduction in the year you fund the trust. What you give up, the remainder goes to charity, not your heirs. For people with philanthropic intent, this is not a drawback. For people who want to maximize what they leave to their children, a charitable remainder trust may not be the right tool, though it can be combined with a life insurance trust to replace the wealth going to charity. Now let me talk about the mistakes people make with irrevocable trusts. Mistake 1. Setting up the trust, but not funding it. A trust that exists on paper but does not hold any assets does nothing. Your home is not protected because you created a trust. It is protected when you retitle the deed into the trust's name. Your brokerage account is not protected because you mention it in the trust document. It is protected when you change the account ownership to the trust. Every asset must be retitled or redesignated into the trust for the protection to apply. This is called funding the trust, and it is where many plans fall apart. The attorney creates the document, the client pays the fee, and the retitling never happens. Mistake 2. Using the wrong type of trust for the goal. A Medicaid asset protection trust does not help with estate taxes. An ILIT does not provide Medicaid protection. A charitable remainder trust does not help a disabled child. Each type of irrevocable trust is designed for a specific problem. Using the wrong one or combining features incompatibly can void the protections entirely. Mistake 3. Retaining too many rights. The more rights you retain over assets in an irrevocable trust, the more likely the law is to treat those assets as still belonging to you. For Medicaid purposes, if the trust gives you the ability to receive principal distributions, those assets may still be countable. For estate tax purposes, if you retain the right to change beneficiaries or control distributions, the assets may still be in your taxable estate. The trust must be drafted so that your retained rights fall within legally permissible limits, and those limits depend on the type of trust and the specific goal. Mistake 4. Waiting too long. Every type of irrevocable trust has a time element. The Medicaid Asset Protection Trust requires 5 years before it protects you. The ILIT requires 3 years if you transfer an existing policy. Charitable planning works best when the grantor has time to receive income from the trust before the remainder passes to charity. People who are diagnosed with a serious illness and begin researching irrevocable trusts at that point frequently find that the window for effective planning has closed or is closing rapidly. The best time to plan was before you needed to. Mistake 5. Treating the trust as a once and done event. An irrevocable trust is not static. The law changes, Medicaid rules change, tax exemptions change, your family situation changes. A trust created 15 years ago may need to be reviewed by an attorney to make sure it still accomplishes what it was designed to accomplish and that you are not inadvertently violating terms that could void the protections. Now, your 30-day action plan. Step 1. Determine which type of irrevocable trust, if any, applies to your situation. The 4 most common needs: protecting a home from Medicaid and estate recovery, keeping life insurance out of a taxable estate, providing for a disabled family member without disrupting their benefits, and converting a highly appreciated asset into an income stream while supporting charity. These goals call for different trusts. Identify which problem you are actually solving. Step 2. If you are over 60 and own a home, calculate your 5-year Medicaid exposure. What is the monthly cost of nursing home care in your state? What is your home worth? If you needed care in 5 years, would your assets be depleted before Medicaid qualified you? If so, the Medicaid Asset Protection Trust is worth a serious conversation. Step 3. Check the federal estate tax exemption trajectory. As of this recording, the exemption is approximately $13,700,000 and may be cut in half in 2026. If your estate, including life insurance, retirement accounts, and real property, is likely to exceed $6 to $7 million, the ILIT conversation becomes relevant now, not later. Step 4. If you have a family member with a disability, review every account designation and your will or existing trust documents. Anywhere that family member is named as a direct beneficiary represents a potential disruption to their benefits if they inherit directly. A special needs trust should be in place before any of those assets transfer. Step 5. Find an attorney who practices the specific type of trust planning you need. General estate planning attorneys handle wills, revocable trusts, and basic beneficiary planning. Medicaid planning requires an elder law attorney with active Medicaid case experience. Special needs trust drafting requires familiarity with the relevant benefit programs. ILIT planning requires coordination with both an estate attorney and a life insurance professional. The right specialist matters. Robert transferred his home into an irrevocable trust when he still had time to make it work. He did not wait for a crisis. He looked at the numbers, understood what his revocable trust was not protecting, and made a decision that if the 5-year clock clears, will save his family $400,000 in home equity. The word irrevocable sounds permanent and frightening. It is permanent. That is the feature, not the flaw. Protection requires permanence. You cannot have a shield that you can take back whenever you want because the government and your creditors know you would take it back under pressure. The permanence is what makes it real. If you have a revocable living trust and you assumed that meant your assets were protected, this episode was for you. Share it with anyone in the same position. Subscribe to Benefits Decoded. We release a new episode every week covering the decisions that determine whether your family inherits wealth or inherits problems. I am Marcus Webb. Thank you for watching Benefits Decoded. Protect what you built.